Hello, everyone, and welcome back to our series on practice management for qualified financial advisors with Amit. As a part of the series, we pick up crucial aspects when it comes to qualified financial advisory practice. And Amit here will help us share some valuable insights on how can you effectively improve your practice management as an advisor. Today, we're going to be talking about the classic destination versus journey conflict for a qualified financial advisors. We're going to be understanding how can the process become more relevant over mere outcomes when it comes to a financial journey for a client. Thank you, Amit, for being a part of this series.
Pleasure.
So, Amit, my first question, hitting straight to the point, how can a qualified financial advisor deal with their client when it comes to the financial journey? So how can a qualified financial advisor help their client conceptualize the financial journey? When typically every time when a client enters the office, they come with a mindset of specific goals, basically the destination where they would like to reach, and most often ignores the journey, right? So how can a qualified financial advisor deal with this entire bit?
There's this beautiful saying which says, a journey of 1,000 miles begins with one step. But the corollary to that is, the journey gets completed only if one continues to take the additional steps. And those additional steps is the journey. Now, interestingly, in financial markets, we may have a clarity about the goal, but the goal value is a function of a lot of assumptions.
Right.
And those assumptions are not going to be true. So let's say, taking an example that I want to send my daughter for higher education, and I'm estimating certain expense towards her education at a time in future. Now this estimation is based on inflation. I don't even know what the real inflation is going to be, but I've started with an assumption. I won't even know at the time of planning which stream she would actually get into, right? So a lot of assumptions are involved, and to that extent, the goal, while it appears to be a good destination, it actually is just a reference point, and that reference point also keeps shifting.
Right.
And from that point of view, if I have to travel from Mumbai to Delhi, I know that I have to do that travel, and Delhi is not going to shift from there.
Correct.
And that's where in financial planning, financial advisory, planning the journey is one part where the destination becomes important, but navigating along the way is equally important.
Right.
Point number 2, the Mumbai-Delhi highway is very well laid out.
Yeah.
The journey in financial future, because it is future, nobody has traveled that road, and to that extent, humongous amount of uncertainties are involved. And those uncertainties bring a lot of fear. And when there is fear, people tend to act irrationally.
Yeah.
And that's where a QFA needs to do a lot of hand-holding. And that's where a companion in form of a QFA makes the journey possible.
Right.
Not just smoother, I'm saying possible.
Right.
Without a good guide, the journey may not be possible. Right? And if the journey doesn't happen, then there is no meaning of that goal. Because without the journey, you can't reach the goal.
Yeah.
And that's what a QFA needs to understand and put in perspective while talking to the customer.
Right. Right. So, adding to your response here, right, it is imperative for a qualified financial advisor to lay emphasis on the journey, when it comes to achieving a specific milestone. But how can a QFA help conceptualize that for a client, Because when the client walks into the office, they have the milestones set in their mind. What becomes more important is laying down the journey on how can you achieve that specific milestone. That's one. 2, sticking to that journey, what you just mentioned, right?
Right.
So if you can explain with an example as to how a qualified financial advisor can actually hold the hands of a client, help them visualize the journey, and how can they go about it when the client is absolutely blank?
So, the whole problem is with the way we look at the components of the vehicle, and that vehicle happens to be the financial instruments or the investment portfolio.
Right.
if we look at it in a holistic manner, it becomes very different. So let's take a journey example, because we are talking about journey.
Yeah.
If I'm traveling by a car, should I focus on whether the car is on the right path or whether the piston is moving forward and backward? If I keep focusing on the piston's movement,
Yeah.
then I'm likely to feel that whether I'm progressing in the journey or not. But if I see that the whole vehicle is moving towards a goal, then I get better comfort.
Right.
Now, take it into the financial markets. Every now and then when you open a television set, you open any website, you open any app, everywhere there is some news about some component of that market. So let's say index has gone up or gone down, interest rates have gone up or down, house prices have gone up or down, whatever may be the case. And the moment you focus on those components, the mind starts to play games with yourself. The QFA has to bring that focus back onto whether the vehicle is moving forward towards the goal or not. The journey is not dependent on that piston movement. Piston movement drives the vehicle.
Yeah.
And that's the importance of it.
Right.
A lot of times, the situations change. And we may come across roads which are potholed in a normal course.
Right.
Now, look at those potholed roads as the volatility in the market or a credit default in a debt paper.
Right.
So these are potholes. Now, what does a good vehicle do when one has to go through those potholed roads? The shock absorbers have to be powerful. And number two, the driver has to control the speed of the vehicle.
Right.
So the people sitting inside the vehicle do not feel those jerks.
Yeah.
And that's how the portfolio gets constructed. Now, if I am old, if I am weak, if my muscles don't support, then the driver has to take cognizance of that fact and drive slowly so that the passenger inside the vehicle gets less amount of shocks.
Yeah, your jerks are bearable.
Right?
Yeah.
But if I'm a youngster, if I'm full of energy, then that fast journey may be okay.
Yeah.
And that ability to withstand those jerks and shocks is nothing but the risk profile of the customer or the investor. So the QFA has to keep those things in mind.
Right.
And once you align the risk profile with the portfolio, align the risk profile with other components of the financial plan, then the journey becomes bearable.
Right.
And the bearable journey is more likely to be completed. Otherwise, the investor is going to bail out midway.
Correct.
And this is where the conversation between a QFA and a customer becomes imperative.
Yeah.
The QFA, though not technically that way, but plays to an extent some role of that driver of the vehicle.
Yeah.
Though it is not exactly the same analogy, but to some extent, I mean,
They seem to be in control of it. They have to be in control.
They have to ensure that the vehicle is constructed well and is strong enough.
Yeah.
I'll give an example. We often talk about the importance of contingency fund. If somebody is, let's say, it's a double income family.
Yeah.
Both are doing jobs in reasonably good companies, or both are working for a government. In such cases, the certainty of the income is more or less there compared to a single income family with the earner being a self-employed.
Yeah.
There the uncertainty goes up. Now in both the cases, you need contingency fund, but the amount of contingency fund varies between the two families.
Right.
The double income family, the probability of both of them losing job is much lower than the self-employed person losing income.
Correct.
So you add that shock absorber in this self-employed person's life, and that shock absorber has to be better. Look at the other way. There are a few people in whose case there could be some medical condition. If there is a medical condition because of which health insurance may be limited, again you need a better shock absorber in form of larger contingency fund. Right? So the QFA has to take cognizance of all these facts and help construct a portfolio. Only then the journey would be completed.
Right. Now, I really like the way you put it through this example, because Delhi to wahi hai. Delhi is fixed, right? If your journey is smooth, that doesn't mean that acha rasta acha hai to chalo kahin aur chale jate, you know. The destination is fixed. You need to be sure about the kind of journey you are taking, and that's the role the QFA helps the client take.
Absolutely.
I really like the way you're putting that up as an example. Amit bhai, my next question to you is that in the last couple of years, close to a decade, we've seen a lot of technology evolve when it comes to financial services, especially at a consumer's level of financial services. A lot of tools available that helps you calculate how you can achieve a specific goal or a milestone, right? But most often these tools may fail to deliver the roadmap to achieving that milestone, or the shock observers like you mentioned. So catering to today's client, how can a QFA deal with such a client where there are tools available, versus how can the QFA make the client feel the importance of a human element in the entire journey, and why is it important, and how the human element can add value in crafting the journey to achieve that milestone over simply a calculator helping you understand how much SIP is required on a monthly basis to achieve a specific goal.
So the calculators are very powerful tools, and there's a huge amount of utility in those calculators. Having said that, if one is not able to put the calculations in perspective and align it with the unique situation of that person, then those calculators may turn out to be dangerous.
Right.
It's like, the most famous example is Alfred Nobel invented dynamite. He invented it for the purpose of mining operations, but it is used more for destructive purposes than constructive ones. Sometimes the tool is great, but how it is used makes the whole difference. So let's take a few examples here. March 2020, and I'm taking my personal example. The writing was on the wall that the market crash was an overreaction to COVID situation, right? From January's level, the market dropped by around 38-40% in no time, or 40 days or so, it fell. At that point in time, there was one class of investors who said, this is the time to borrow money against your own portfolio and invest in equity markets. And they did, and they actually laughed their way to the bank. But there was another class of people, and I belong to that other class of people. Till March 2020, I was only doing physical training sessions. I had not done a single webinar or online session, right? Because we were going into lockdown, I could only see that my business is closed. In that situation, is it prudent to borrow money and invest? The answer is no. So what do I do in that situation? While I could see that opportunity, what do? I redeemed some money to increase my buffer. Because earlier I had contingency fund for 3 months worth of expenses. I doubled it to 6 months straight away. Right? So while I could see that opportunity, my situation did not permit me to take advantage of it. And that's the uniqueness. Now, do I regret it? No, I don't regret it. I had taken a decision to be an independent, self-employed person. So whatever the consequences, I had to face. Now comes the role of a QFA. At that point in time, what does a QFA tell the client? The QFA cannot say that today is an opportunity because market has fallen. He has to say, while there is an opportunity, you are not in a position to take advantage of it. So you stay quiet. It's like there is a very, lavishly laid out dinner.
And you're on diet. Yeah.
Now, these are the nuances that the QFA brings in. Because if somebody who's diabetic eats that lavish dinner, or somebody who's got stomach upset and eats that lavish dinner, it's the journey that gets impacted.
Right.
And when the journey gets impacted, forget the goal.
Right.
Right? So these are the situations where, while the calculator tells you something, the situation tells you something else.
Right.
One of the most interesting points that is often discussed is about, if I have money available right now, should I invest that money or repay my loan? Very often this question is discussed.
Okay.
And the answers from the calculator tell you something. But look at it this way. If I invest the money, am I sacrificing the liquidity that's in hand? If I have liquidity provision elsewhere, then it's okay to repay the loan. Because once you repay the loan, that money is not available with you.
Correct.
Or you have an alternative plan that you completely clear the loan, so now you can borrow against that asset.
Right.
Because in that case, liquidity becomes paramount.
Correct.
Right? And calculator will not tell you about that liquidity situation. It will only tell you whether this is a wise decision or not.
Right.
Third, repaying a loan versus investing. The moment the return on investment is assumed to be higher than the interest on loan, obviously you are taking some investment risk.
Correct.
The calculator doesn't tell you about that risk.
Right.
And that's where the QFA comes in. So calculator tells you a lot of things. It's a good tool. Put it in perspective is what a QFA does.
Very, very rightly put. Amit bhai, my next question is on adaptability and resilience when it comes to the decided financial journey, right? In your earlier response, when you mentioned that in your journey there will be curves and potholes and a straight stretch as well, but the car needs to be equipped with the right kind of shock absorbs for the passenger to have a smooth journey. So my question to you is, if you can help us understand in a better context, how can a QFA have such shock absorbers in the car for the journey? Because once a journey is decided for the client, there will be a lot of challenges during the journey, like you mentioned, external macroeconomic factors, right? A war could happen, COVID could come back, or simply the market is correcting, right? Priorities might change, liquidity situation could change. Anything could happen. There could come a lot of challenges in the journey, but if the destination has been identified, how can a QFA help the client be more adaptive and resilient to the challenges that they would face in the journey?
So, first of all, there are two parts of the journey. One, the vehicle has to be robust enough that it does not break down.
Correct.
And second, the word resilient means that if you fall, how soon you can get up back, right? So resilience and robustness both are equally important.
Right.
So let's again use the example of a vehicle. Why do you have a brake in the car? And a lot of times when you ask this question, people would say, so that you can slow down.
Right.
No, not really. The real reason of having a brake in the car is so that you can drive fast.
Yeah.
Right? Without the brake, if you drive fast, you are bound to meet with a deadly accident.
Right.
But if the brake is available, you can comfortably go, and then when required, you can use the brakes.
Right.
What are the brakes in an investor's portfolio? And that's where a few things which appear to be reducing the upside are actually the brakes in the portfolio. Take, for example, even for a very long-term goal to a very aggressive investor, leverage may not be a great idea. Leverage is a huge accelerator, but that's without a brake. Number two, only buying stocks in one company, and which is what a lot of entrepreneurs do. They are working to build a company and their entire personal capital is also invested in the same company, right? So that's a huge concentration. If things work out, there'll be a huge upside. But if things don't, then what, right? Now, you don't really play lottery with your life, with your financial life. And that's where you don't really look at 100 becoming 100,000.
Right.
You look at that 100 becoming 200 and 200 becoming 500 over a period of time. And that's the journey that one has to take. Because the moment you are aiming for that 100 to become 100,000, that 100 can straight away go down to zero. And you are out of the game. So, what do you need? In that case, a diversified portfolio is a great shock absorber.
Right.
Because if something goes wrong somewhere, it may not go wrong at other places.
Yeah.
And this diversified portfolio would mean you are diversified across companies, across industries or sectors, across asset categories, and across geographies or currencies. The moment your portfolio is diversified, then it can absorb more shocks.
Right.
Take, for example, when there is a war or a fear of a full-blown war,
Yeah.
gold price tends to move up.
Correct.
So if you invested in equity and gold, you're balancing it out.
Right.
Right. Now, that's one advantage of diversification. The second thing that one can do is to, and we keep highlighting in various programs and episodes, the power of contingency fund, the power of insurance, right? Those are essential safety mechanisms in a portfolio.
Right. Your airbags.
Your airbags. It's like when I look at a cricketer going out to bat, I would prefer that the batsman doesn't wear pads so that he can run fast.
Yeah.
Yeah? The pads slow down the speed of running. But if he doesn't wear the pads, he may never be able to play another game again.
Right.
So that's where the insurance and contingency funds come in. So these are safety mechanisms, the airbags and safety safeguards. And that's where a QFA has to keep highlighting the importance of these things. That for a better journey, for that batsman to score 100, wear pads, wear gloves.
Yeah.
They don't hamper the performance, but these are essentials. Right? So just to repeat, contingency fund, insurance, which includes health and life insurance and other forms of insurance. Then when it comes to investments, it has to be a diversified portfolio.
Correct.
Then again, as per the asset category you invest. So if the goal is near term or short term, you don't take exposure to equity. If the goal is long term, by all means take exposure to equity.
Right.
And then finally, instead of buying stocks oneself, if professional help is available, that's another great risk management tool.
Yeah.
And I'm not referring to the professional's ability to beat markets. I'm saying it's a great risk management tools, because whenever a professional manager is involved, the regulator puts certain safeguards through certain boundaries and controls. He can't play outside of those. So the accidents don't happen too much when it involves a professional fund manager, but when there is an amateur and independent individual, there is a higher probability of accidents.
Right.
Now, these are the things that a QFA can bring into the discussion, highlight it again and again. The objective, like a marathon, is to complete the race and not to come first.
Right.
So you don't really run like a 100-meter sprint,
Right.
but you stay in the race. You keep running, you complete that 42 kilometers. That journey needs to be completed, and that's where all these safeguards become very, very important. Your portfolio must be robust and resilient at the same time.
Right.
And then it can really take off.
Makes sense. Yeah. My last question for this segment today, Amit bhai, is that for those QFAs who are looking at refining their approach, or for those QFAs who've recently entered into this community of advisory, what would be your take or your advice for them as to how can they have a journey-centric approach for their clients? What can be their starting point, and what are the things that they should keep in mind?
So Bernstein wrote a book called The Four Pillars of Investing. And one of the four pillars of investing is the investor psychology. Another pillar is the history of financial markets. And in my understanding, that history of financial markets teaches you a lot about the psychology of investors. And that psychology is important to understand because it's because of how the mind plays games, one discontinues the journey. It's not so much about the path. Often, it's the mind that does not allow the journey to be completed or the journey to be smooth. And from that point of view, any QFA, whether a beginner or a veteran, I would say keep learning about what has happened in the past and relate it to the mindset of the investors.
True.
A lot of times people say that, the market went down and every time the market went down by so much, it went up again. That's okay to see. Those numbers are there for everybody to see. What did the people do when the market was high? What did they do when the market was low? Let's take one example of this market. And that's where the QFA has to relate to the real events. March 2020, the market fell and immediately recovered in no time. So from that level, the bottom of March 2020, by the end of the year 2020, the Sensex or Nifty were more than double. And they were at a higher level compared to the previous peak.
Yeah.
So they actually were at all-time high.
Correct.
Funny enough, when we had 600 cases, the crash happened.
Yeah.
And when they crossed the peak, all-time high, that time we had 1 crore cases of COVID in India, right? Now, what does it tell you? It tells you that in anticipation that the worst is over, the market had already moved on.
Right.
But we may not be able to see it at that point in time. Can a QFA understand this part? Now, this is one. The moment the recovery happened fast, people have started believing that every time the market falls, there'll be an immediate recovery.
Correct.
So I would say, just go back a few years, 2008 to 14.
Yeah.
6 years, and if somebody entered at the peak, the person did not make any money for 6 years.
Right.
It was only after around June 2014 that that level was breached permanently forever.
Right.
We've not seen going back to 21,000 Sensex or whatever level.
Right.
The interesting part is, the difference between this and that is the recovery was quick. In this case, one had to endure the pain of not seeing returns for very, very long period.
Yeah.
The investor behavior is likely to be very different in both the situations.
True.
So if I understand the history and relate it to the investor behavior, I'm likely to be better. And of course, the QFA needs to have the technical knowledge of various financial instruments.
Correct.
Right? And finally, the one episode that we did on empathy.
Yeah.
The empathy is put yourself in the client's shoes and think, what would you have done in that situation? And that's what I would recommend for any new QFA.
Thank you. Thank you so much, Amit Bhai, for sharing your insights today. What I loved about this entire series of conversations that I've had with you in all these episodes is that the profession of financial advisory or the profession of a qualified financial advisor is comparable to so many other noble professions. And you get to learn so much about this profession when you see it through the lens of others' professions, right? For example, we compared this profession to a doctor's profession. Today in this episode, we understood how important it is to design a car which is safe and also ensure, the passengers seated in the car are feeling comfortable and yet could reach their destination. So is a profession of a financial advisor.
Absolutely.
This was the last episode in the series of practice management for qualified financial advisors with Amit Bhai. Thank you so much for watching the series. We hope you enjoyed watching it. We hope you took back some valuable insights, and you can take this learning back to your practice and make your practice more efficient and deliver much more and much better impact to your clients. Amit bhai, thank you so much for being here with us and doing this series and sharing all your valuable insights. It's always a learning when we meet with you. Thank you so much.
Thank you so much. Pleasure.